Okay, let's jump right into this explainer, shall we? Today we're unpacking something super fascinating, how international finance literally shapes domestic government policies. We usually think of national budgets as entirely local decisions, right? Made by elected leaders for their own citizens. But actually, there's this massive, invisible force sitting right there at the table with them, global credit rating agencies. We're going to look at a highly revealing case study that just played out in Indonesia, where one single shift in a financial outlook sparked a massive scramble by the government to prove its fiscal discipline.
So this brings us to a crucial question. Can a single financial report genuinely alter how a sovereign nation manages its money? Seriously, think about it. When an agency sitting in an office in New York or London shifts its perspective on an emerging market, it doesn't just bump stock prices around. No, it can literally force presidents and finance ministers to instantly rethink their spending, their messaging, and even their long-term economic strategies.
Here is our quick roadmap for the explainer today. We're going to start with the negative outlook shock. Then we'll look at what exactly spooked global markets, explore the whole Dantanarma dilemma, examine the government's fiscal discipline defense, and finally, look at how they balance growth and ratings.
All right, Section 1, a negative outlook shock. Indonesia's reality check.
To really understand the stakes here, we have to look back at Indonesia's incredibly hard-won journey to regain investment-grade status after the brutal 1997 Asian financial crisis. I mean, it was a long, painful road of strict structural reforms and super tight spending controls, but they did it. They finally won back that investment-grade rating from Fitch in late 2011, then Moody's in early 2012, and S&P Global in 2017. And let me tell you, this status, it's a massive badge of honor. It basically shouts to the world that your country is a safe place to invest, which keeps borrowing costs low and keeps global capital flowing in.
Fast forward to February 5th, 2026. Moody's Ratings decides to maintain Indonesia's sovereign credit rating at Ba2, which, is one notch above that investment-grade threshold. But, and here's the kicker, they revise the outlook from stable to negative. Now, in the high-stakes world of global finance, an outlook change is a giant flashing warning sign. It essentially means, hey, a downgrade could be right around the corner if you don't course correct. And boom, it instantly rocked investor confidence and put the Indonesian government on ultra-high alert.
Let's move to Section 2. What spooked global markets? The triggers.
So what actually caused this? Well, Moody's specifically called out three main factors that widened fiscal risks and basically spooked global markets. First up, they noted increasing macroeconomic policy uncertainty under the new administration. Second, they pointed to direct fiscal risks from a really massive expansion in social spending. We're talking specifically about a free nutritious meals program for school children, which is budgeted at a staggering 268 trillion rupiah, alongside some big new public housing initiatives. And third, they flagged the highly complex structure of a newly established sovereign wealth fund. All of this combined, it signaled a potential departure from the decades of strict spending discipline that investors had totally come to rely on.
This perfectly illustrates a classic core tension, right? We're looking at contrasting domestic political promises against the cold, hard math demanded by international rating agencies. The government understandably wants to boost human capital. Providing free meals integrates local farmers, strengthens food security, improves health. It's a big deal. But Moody's looked at this and just saw an incredibly expensive program squeezing an already tight state revenue space. Their fear was that it could crowd out other productive investments or push the national debt way up. It's that classic clash, domestic social priorities versus the very rigid expectations of fiscal conservatism.
Okay, Section 3, the Danantara dilemma, a massive superholding.
So, we need to talk about Danantara. It was created to optimize strategic assets, but its highly complex structure raised some major governance concerns globally. The government's vision here is actually pretty bold. Danantara is designed to act as an investment management agency, basically a super holding company meant to streamline state-owned enterprises, drive corporate efficiency, and fund massive national development projects, like major downstream industrial initiatives. The ultimate goal is for it to act as a catalyst for sustainable commercial returns.
But here is exactly why the market panicked. $900 billion. With an estimated $900 billion in assets sitting under its umbrella, analysts were seriously worried this massive institution might start to blur the lines between the official state budget and commercial corporate debt. Moody's explicitly came out and stated that this new institution added policy and financing uncertainty. The big fear? That the state's official liability boundaries would get fuzzy. Like if a state-owned enterprise under Danantara takes on a mountain of commercial debt for a development project, is the government ultimately on the hook if things go sideways?
that specific lack of clarity is exactly what rating agencies absolutely despise.
Moving on to Section 4, the fiscal discipline defense, anchoring the budget.
So how do you defend against this kind of pressure? The immediate defense relies on strict adherence to Indonesia's statutory budget deficit ceiling of 3.0% of GDP. This rule was actually put in place right after that 1997 financial crisis, and it serves as the ultimate fiscal anchor. By law, the government literally cannot spend more than 3% beyond its means. It is the absolute gold standard of Indonesia's macroeconomic stability. So naturally, the government immediately rushed out to reassure markets that this ceiling is 100% intact.
And to really prove their commitment to discipline, the government targeted an even tighter 2.68% deficit for the 2026 budget. This is a highly deliberate signal. They're essentially saying to the world, hey, not only will we not break the 3% rule, we're actually aiming well below it. It acts as a mathematical promise to the international community that despite these new social programs and new investment vehicles, their overall fiscal prudence is absolutely not going to be sacrificed. And the official data actually backs this up, confirming that budget financing remains highly credible and completely on track. The data proves they aren't just out there making empty promises. The real numbers coming in actively match their disciplined projections.
I love this quote because it shows the very real human policy response to these institutional rating pressures. When Moody's dropped that negative outlook, Deputy Minister of Finance Judah Agung publicly declared the 3% rate is non-negotiable, period. He even mentioned that they were treating the whole Moody's report as a lesson learned to better prep for upcoming assessments from other agencies like Fitch and S&P. It's a perfect example of exactly how credit ratings act as a super strict disciplinary force on government officials.
Right after the downgrade, President Prabowo ordered a very sharp communication pivot. This really demonstrates that credit ratings dictate not just what governments spend, but how they actually talk. The president instructed his entire cabinet to be completely open and proactive in communicating with global financial markets to restore that lost confidence. The coordinating minister for economic affairs laid out the immediate steps. First, state banks and the government started engaging directly with the rating agencies. Second, Danatara was ordered to crystallize and clearly explain its governance boundaries to prove beyond a doubt that it wouldn't act as some shadow budget. And third, they broadly reaffirmed their strict rules-based fiscal framework to the world.
Finally, Section 5, balancing growth and ratings, the long-term view. You know, despite the whole outlook shift drama, Indonesia's economic fundamentals actually remain remarkably strong, outpacing quite a few major global economies, actually. The government was super quick to point out that their 2025 GDP growth hit 5.11%. They're sitting on massive foreign exchange reserves of $156.5 billion. Plus, the central bank, Bank Indonesia, has maintained an accommodative policy rate of 4.75% to stimulate the real sector while keeping inflation perfectly stable. The core message they are broadcasting is clear. Yes, we have new initiatives, but don't worry, the economic engine is running incredibly smoothly.
And their external stability is really bolstered by a significantly lower debt-to-GDP ratio compared to similar developing countries. If you look at peer nations, places like the Philippines, Mexico, or Hungary, Indonesia's external debt burden remains noticeably lower. This is such a crucial buffer. It essentially proves that those decades of hard-fought fiscal conservatism have built a really resilient foundation, one that can totally withstand both global volatility and domestic policy shifts.
Which leaves us with this final, kind of provocative thought about the ultimate influence of credit rating agencies on sovereign nations. In a world completely defined by global capital, who really writes the national budget? A government might win an election on promises of massive social spending and bold new sovereign wealth funds. But, as we've just seen in this explainer, the absolute second a credit rating agency issues a negative outlook, that same government must immediately pivot, firmly cap its deficits, and justify every single dollar to international investors. It's a really fascinating reality of modern economics. True sovereignty today requires absolute fiscal discipline, heavily dictated by the global market. Thanks so much for joining me on this deep dive into the real mechanics of fiscal policy. Keep learning, and I'll catch you in the next explainer.